Welcome to Veranda CA. In today's session, we are going to cover the portions of double taxation relief. So it's one of the critical portions as far as international taxation is concerned. To entirely understand how this international taxation concept works, one of the critical thing is this double taxation relief. So what exactly is double taxation relief, or why is this probably required? So when you actually look at this Income Tax Act, in today's globalization, we could see that there are cross-border transactions. When you say cross-border transactions, it is between countries. So there are transactions between one or more countries. So effect of taxation becomes very important in such transactions. So when you say, as a result of this globalization, we could see that there is one country's domestic tax policies could impact the economy of the other country. So when there is a transaction between, let's say, India and USA, there is a possibility or there is a scenario because of this globalization, the impact of this Indian transactions with the American entity will impact both the countries' economy. So one country's domestic tax policies will indirectly impact the economy of the other country. So this is the reason why we are going to discuss about this double taxation. So when you say there is a transaction between two countries, generally, what do we say? In India, we speak about this residential status concept. We try to understand whether a company is a resident or non-resident. We had also understand how do you probably determine this residential status of a company. We said through POEM. For a foreign company could also be treated as a resident in India through this concept of POEM. So what happens? It is actually a foreign company. Let's say it is an American company. So it is based out of America. But for the purpose of taxations, certain incomes are also taxed in India. Why? Because we saw various reasons in section 9. We saw that there could be business connection. We saw that there could be significant economic presence. Say a property is located in India or a source is located in India. So when we talk about these concepts, two critical words that comes into our mind is one is source-based taxation, another is residence-based taxation. So across the world, taxation is based on two concepts. Either a particular transactions could be based out of source or could be based out of resident. So when you say source, what do you mean by the word source? It is typically where the income arises. We also saw in section 9 that certain income could be deemed to accrue or arise in India. So such income will be deemed to be taxable in India even though they are not a resident of this country. Even though they are a non-resident, certain incomes becomes taxable in India based on source basis. So there is this two concept, that is your source basis taxation and residence based taxation. So when you talk about this, what do you mean by source? As we said, it is basically where the income originates. So that is where we saw in section 9 that when an income originates, it could be deemed to be originated. It could either be actually originating in India or it could be deemed to be originating in India. So that's what you call it as income deemed to accrue or arise in India. Such taxation is called as source concept. So a person who is a non-resident is still taxable in India because of the source based. And similarly, when the tax where assessee actually resides, right? So that becomes the host country in which they probably have registered as an entity. So it's let's say in India you register a company through Companies Act 1956 or 2013. So such company is called as an Indian company which automatically becomes a resident. So similarly, a country where that particular company is registered, it could be called as an resident of that country, right? So now for a particular transaction, the income will be taxed in USA because they are registered. They are a company incorporated in USA laws, so they are taxable in USA. And according to section 9, an income is taxed in India because it is deemed to accrue or arise in India on source basis. So there is a situation, a same transaction is applicable. That is, both the source-based taxation is applicable and residence-based taxation is applicable. That is where the concept of double taxation comes into picture. That is where both the rule coexist, both the source-based taxation and residence-based taxation coexist in such scenario. So in this scenario, what happens is you enter into an agreement called double taxation avoidance agreement. That is, between countries, two countries can enter into an agreement called double taxation avoidance agreement. The very purpose of trying to minimize this impact of where there is a concept of this double taxation because of this, where source-based taxation and residence-based taxation coexist. Now, when you talk about relief, we said there is a double taxation, right? So, when we said a same transaction is taxed both on source basis and on residence basis. Now, it creates an hindrance, it creates difficulty to the taxpayer of that particular country or whichever country they belong to, because they are taxed in both the countries on the same transaction, which means their profits gets reduced. Their net profit that they actually enjoy gets reduced. So, there must be a relief concept to make sure that there is no double taxation involved. So, the concept, what happens in this double taxation is a relief concept. So, when you say relief, we said it is also taxed in source based and also taxed on residence based. Now, this taxation, both the source and residence, what happens? Who should give credit, or what should actually happen to this taxation? Should we say, see, for this particular taxation, you don't tax in source, let it be taxed only on residence? Should we do this? Or let's say both of them tax, I'll give you a credit. Both of these scenarios are possible. So what happens here is, India has entered into various double taxation avoidance agreement. That is, they have over 100 DTA. They have with Sri Lanka, they have with England, USA, they have with so many countries. So there are over 100 double taxation avoidance agreements entered by India with the respective country. So these agreements are called bilateral. So because both these countries have an agreement. When this comes into picture, it is called bilateral. When there are no DTA, India will have its own tax laws, that country will have its own tax laws. There is no intermediary, there is no discussion on what has to happen when both income is taxable in both the countries. So what do you do then? So we are going to see how is a relief provided in both these things. So typically in a bilateral, that is whenever there is a DTA available, whenever there is a DTA present between two countries, that is in a bilateral scenario, there are two possibilities. One is exemption. That is, as we first said, it will be very clearly stated that, see, this income is only taxed in India, not in USA. This income is taxed only in USA, not in India. This income is only taxed on source basis, not on residence basis. So, similarly, there could be various probabilities. So, typically the point is, it will only be taxable in one country, the other country will not tax. The other country will not tax. So, that is called exemption basis. And you also have this method called tax credit, which is a common approach, What do you mean by credit? I guess the word itself explains you what it could mean. So, typically it says, like your tax deducted at source, whenever a tax is withheld for a particular income, what do? You adjust the tax deducted on your behalf with the income that you are actually reporting. So this particular proportion, what we are talking, is called tax deduction at source, which is taken as a tax credit, which is like your advance tax. So similarly, between DTAs, they agree, they say, if both countries are taxed, give credit in the country in which they are actually a resident. So in the country of residence, give them the tax credit. So this is a common approach because there is no ambiguity in about who should tax and when should that be taxed. So to avoid this, one of the common approaches is a tax credit approach, which means one country will tax, the other country will also tax, and the resident country will give you tax credit to say that to this extent, you can take credit of whatever you have borne in that other country. So, to avoid double taxation, this tax credit is one of the common approach. Whereas this unilateral, the provision is discussed in section 91, where no DTA is applicable. For such transactions, section 91 provides what has to happen to such transactions. How does the credit mechanism work? So this foreign tax credit that we are talking about, the FTC, the foreign tax credit, is discussed. The details are provided in a rule 128 and to explain, to provide the scenarios or the procedure in which a foreign tax credit must be, can be availed by that particular taxpayer in India. So this is basically where India is the resident country for that particular assessee. He can claim foreign tax credit because the same income has suffered taxation in another country because of source concept. So that is what we are talking here as unilateral. So this is where this double taxation act, that is avoidance agreement, plays a great role. So now let's understand the provisions of section 90. So when you say section 90, We said 91 is unilateral. So 90 and 98 deals with this bilateral agreement. So 90 is basically between two countries on a broad level. So there is an agreement which covers various scenarios. One of the primary roles, primary requirement of this bilateral, that is section 90, is the intention of this provision itself is to provide relief. So to provide relief to the resident for claiming relief where same income is taxed in two different countries. Now, as we said, the very purpose of this double taxation avoidance agreement, that is wherever bilateral agreement is entered by one country with other country, since we are talking about this income tax act, let's say with India and another country. So the purpose of this agreement, as we said, it is to grant relief for what? It is to grant relief for where an income is taxed in both the countries. But not every time an income could actually be avoided. That is, double taxation could not necessarily be avoided in every scenario. So basically the intention is avoidance of double taxation. What happens is there is a possibility of treaty shopping. So what is treaty shopping? You pick the treaty, see whichever clause is beneficial to you, or probably you see whichever country is beneficial to you, transact in such countries so that you avail the relief that is available to you. So you misuse the provisions by using this treaty shopping so that you can avoid double taxation. So for the sake of avoiding double taxation and claiming relief, you enter into a transaction in such a way that you shop a treaty, that is you pick a treaty which is more beneficial to you and accordingly transact. So this is also one of the intention of the section 90 provisions. The third one is exchange of information. There are certain agreements, as we said, there is double taxation avoidance agreement called as DTAA. You also have agreement called as exchange information agreement. So such agreements will be primarily for the sake of exchanging information from one country to another country. So what exactly happens is when one country wants to share information with another country, let's say you have an issue with someone in UK, you wanted that particular department, tax department, the revenue department of United Kingdom to share you certain information. Such clauses, that is this agreement, that is the exchange information agreement or relevant clauses, could facilitate in sharing of information between one country and another country. The next thing is recovery of income tax. So as we said, when you speak about this taxes being applicable in both the countries, we said there might be a situation where you need information from that country. Similarly, there could be a situation where a concerned person who is residing in United Kingdom is supposed to pay tax under income tax law. So there could be clauses in the agreement which will facilitate recovery so that India can collect taxes of that person from with the help of that government, because the treaty provides clauses which will help you in recovering the income taxes. So it will typically have what should be done at the time of recovery. So these are the primary intention of section 19, that is you wanted to grant relief, you wanted to make sure that treaty shopping is not done so that there is an avoidance of double taxation, and then you facilitate, the agreements should facilitate exchange of information, and finally an agreement should facilitate recovery proceedings. Whenever a tax has to be recovered, it could be supported, that is recovery proceedings should be supported through the agreement. So these are the primary intentions of section 90. Apart from this, we said the provision of this act. So whenever there is an agreement, let's take there is an agreement between India and United Kingdom. Now there is a particular clause which is more beneficial to the assessee, whereas Income Tax Act is the other way around. When you compare the provisions of Income Tax Act and the provisions in Double Taxation Avoidance Agreement, then if it is beneficial, that is whatever clauses has been stated in the Double Taxation Avoidance Agreement is more beneficial, then in that case it will be applicable. That is, the provision specifically says whatever is beneficial to the assessee. That is, you compare this section Income Tax Act provisions and the provisions specified in Double Taxation Avoidance Agreements, whichever is beneficial to the assessee is free to choose that mode. Let's say a particular income, a royalty income is taxable under section 9. So section 9 says royalty income is deemed to accrue or arise in India. So the country has to remit taxes in India also. So this is a particular section. Let's say that DTA, as we said, let's take for example US. US provides a clause which says this is not taxable, not taxed in India. What happens? Such transaction, since DTA says it is not taxed in India, since this is more beneficial to the assessee is free to adopt this DTA rather than the provision specified in Income Tax Act. So DTA overrides the provisions of Income Tax Act. So that's what this ideally means. Now, as we have already discussed in various sessions, there will generally be exceptions to most of the clauses. Similarly to this section also, there is an exception. The exception is Chapter 10A. That is your general anti-avoidance rules. So what does this mean? If there is a situation where an agreement is considered to be an impermissible avoidance agreement, which means, in simple words, the intention of that agreement itself is to avoid tax. So avoidance of tax is the primary objective of that agreement. So that conditions, such agreements fall under this Chapter 10A. Now, this exception, whichever is beneficial to the assessee, shall not apply to this Chapter 10A. So whatever agreements fall under this Chapter 10A, in that case, this exception of whichever is beneficial to the assessee shall not come into the picture. So there is an exception to it. And then generally in various international laws, there is a provision which says there should not be bias. There should not be bias between a foreign resident and a local resident. That is a resident and a non-resident. There should not be bias. So you should have similar provisions for residents and non-residents, and you should not make a foreign resident pay more just because he is a foreign person. So this is a general international law, a general theory. So, but if you actually see in India, the tax rate of this foreign company is 40%, right? The tax rate of this foreign company is 40%. So such tax rate, the 40% is higher than what you generally charge for a resident, right? So, but this explanation 1 to section 9, that is section 90, clearly says this tax rate difference between a foreign company and an Indian company does not mean it is less favorable. So, when you say preference should not be given to a resident over the foreign company, by saying that the foreign company is taxable at 40% and the domestic company is taxable only at, let's say, even 15 or 25%, that doesn't mean we are creating a bias. We are creating a less favorable situation to a foreign resident. So it very clearly provides in the explanation saying that this will not be considered as a bias created as specified in the international law. So this is about section 90. Moving on, we need to understand in this section 90, there is a very clear directions as to what will be the meaning of the terms. When you say the meaning of the terms, there is an Income Tax Act, there is a double taxation avoidance agreement. There could be a scenario where there is a term which is also defined in Income Tax Act, which is also defined in double taxation avoidance agreement. So there is a clear direction in section 19 on how to go about that. So basically, when the term is not defined in the agreement, that is, it is not defined in the DTAA, but it has been provided a meaning in the notification to such DTAA. So such meaning, whatever has been provided in the notification, will override the definition of what is provided in the Income Tax Act. In case if it is already defined in DTAA itself, then whatever meaning is applicable there will be applicable. So here also it overrides the Income Tax Act. So the only situation where the Income Tax Act definition will be considered is it is not defined in the agreement but defined in the act. So in such scenario, whatever is the meaning in the Income Tax Act. So when you say in IT Act, so whatever is meaning in that Income Tax Act will be actually applicable to you. So that is with respect to the definitions, the terms, which terms should be considered, the meaning of the terms, how should it be considered. The next thing that we need to understand is when you say relief is given through double taxation avoidance agreement, one of them takes a credit, that is in the resident country, the other person takes a credit. In, for example, a royalty income is taxed in India because it is deemed to accrue or arise in India. The same income is also taxed in US based on residence basis. Now what happens? They need to claim relief according to the double taxation avoidance agreement. Whatever is provided in the laws, they will have to take credit. There was a situation where there was misuse of this provision, that is, relief was claimed from a person who's actually not a resident of that country itself. So what happens is, when there is a misuse of provision, to make sure the transaction is happening only between this country and that country, and this DTA is what has been gone through, section 90 subsection 4 provided this concept of TRC, that is your tax residency certificate. So what is this tax residency certificate? Is basically to authorize the income tax department of that particular country says so and so company is a resident of United Kingdom. So they are allowed to take credit of that. So you let them take credit because they belong to that country. So what happens is, there is a provision provided exclusively for this purpose to reduce or to completely restrict misuse of this relief claiming. Though you are not a resident of that country, you are still claiming a benefit. So to avoid this, the concept was introduced, saying a tax residency certificate must be shown of that relevant country. Only then they can claim the benefits of this double taxation avoidance agreement. So this becomes very vital with respect to claiming the relief. So it becomes a very important portion for claiming a relief. Tax residency certificate is mandatory to claim a relief under DTA or section 90. Now, specific provision of DTA shall prevail over general provisions. So, whenever there are different types of provisions in taxation agreement itself, as we said, DTA overrides Income Tax Act. Similarly, specific provisions overrides the general provisions. So, of course, right, because when you say you are going to talk about royalty, if there is a specific article in the particular agreement relating to royalty, you will have to follow that. In case if that is not available, then probably you can use an article which generally talks about the business income or other income or whatever basis. The first priority is to be to the specific provision. So if there is an exclusive section article for royalty, we need to adopt that article only. Similarly, for technical services, if there is an exclusive article for technical services, that only have to be used. So this has been specified in a very old dated circular. So it very clearly says that a specific provision of DTA shall overtake, that is, shall override the general provision. So that is what is there. And next one is, whatever is a foreign taxed income, we need to say that foreign taxed income is basically, what do you mean by an income for which you have to give relief? Basically, for a foreign income, you need to give relief. When you say you need to give relief, for what transactions do you give relief? Which has suffered double taxation. So the primary condition is such foreign income should have been taxed in that particular country. Only then you can claim a relief here. So it should include in income and a relief must be granted. So it must be part of an income in the computation of that particular country and relief must be granted. So it's not like it's an exempt income. It's not like it has been claimed as a deduction. So it must have been part of the total income for which relief is granted. So that's what this relief mechanism means. So when you say relief, relief is provided to an income, a foreign income that has been taxed in that country, included in the total income, and then relief has been granted. So that is what you mean by foreign taxed income. Relief is available only to such income. Next one is treaty models. So we said double taxation avoidance agreement, right? So when you say double taxation avoidance agreement, we don't frame our own agreements. There is already a template. We'll keep this word. There is a template available. There are two templates available. So basically, there is a template provided by this OECD. We said Organization for Economics and Cooperation for Development. So this OECD has provided a detailed structure on how should a double taxation avoidance agreement be there, the structure. Similarly, the United Nations, the UN, they have also provided a particular structure in which a template has been provided for this double taxation avoidance agreement. So this only helps you in pick a agreement. So let's say we are part of this United Nations. So there is a template available for India and other United Nations country. We are not a member of OECD, but we are a following member, which means we follow and we also provide our commentaries to OECD. We adopt certain things which are good in OECD. So basically an Indian double taxation avoidance agreement with a particular country will either be in UN model or in OECD model. Sometimes it could be a mix of these two also. Apart from these two, US themselves have a separate model, but we are not going to talk about that because primary templates are only two. It is one is OECD and another is United Nations model. So that's all about section 90, which talks about what is a double taxation avoidance agreement and then what are the reliefs that are provided. That is what is a possible relief or what is the purpose of this agreements and other things. So that's what we discussed in section 90. 90A is almost exactly similar. Only thing is it is between associations. That is a specified association in India enters into an agreement with specified association of that country. So an association in India, a specified association in India enters into an agreement with a specified association of that particular country. So this agreement gets covered in 90A. Most of the policies whatever we discussed in section 90 generally applies to section 90 also. So when you say what all applies, first thing is purpose. We said providing relief, avoidance of double taxation, exchange information, recovery of taxes. So these are the four primary purpose of double taxation, that is section 90 we spoke about. That applies here also, the purpose of double taxation. What are the benefits? We said relief is provided, a foreign taxed income is provided. We also said when there is a provision which overtakes, that is Income Tax Act provisions, the DTA provisions overtakes the Income Tax Act provision. So that benefit is also available, whichever is beneficial. So that is also available. But such benefit is not applicable for Chapter 10A, which is GAR. So that exception is also applicable to Section 90A. And finally, the requirement of tax residency certificate under Section 94 is also provided in 90A. So to claim this benefit, tax residency certificate is mandatory to claim benefits. And the last one which is applicable in section 90, which is applicable here also, is the definition clause. So whatever definition we are talking about, we said between the agreement and the act, what is the terms that must be, the meaning of the terms that must be applied for interpretation purposes. Same concept whatever we discussed in section 90 applies here also. So that is with respect to section 90A. Moving on, we need to understand about the next category, that is unilateral. So what do you mean by unilateral? You mean by unilateral when you say that there is no agreement with such country. So there is no agreement. So that's the important thing. There is no agreement with such country. How do you still provide relief? That is what discussed is in section 91. We said in section 90 there is very clear. Either you give exemption or you say tax credit, which is one of a common approach. What do you do in case of section 91? Because you don't have an agreement with that particular country. So what do you do? So still it is entitled, right? Because we said it is entitled to a tax credit mechanism, that is in the form of FTC. We said it is available in the form of FTC. So now what are the conditions that needs to be fulfilled to claim a foreign tax credit? First thing is, we said the credit is only available to the resident. So that particular person must be a resident in India during that relevant previous year. Whichever year we are talking about, the person must be a resident of India in that particular previous year. So that is what it is relevant. Second thing is, the income for which they are claiming relief must be accrued or arised outside India. So it is basically not in India, it is accrued or arised outside India. So it is not part of India. So the source is outside India. So typically you can keep this word as source. You are a resident here, but the source of income is outside India. So that's what your meaning as income accrues or arises outside India. Not just that, it is not deemed to accrue or arise in India. So it is not something which is deemed to accrue or arise in India. And so in no manner this becomes deemed to accrue or arise in India. So we saw various clauses in section 9, right? So it does not fall under any clauses of section 9. So this income is taxed outside India. That is, it accrues outside India but not in India. So that's one of the critical thing. Next is, such income is actually taxed in foreign country. So such income is actually taxed in foreign country. So as we said, it must be a, what did we say? We used a term foreign taxed income. When we said foreign taxed income, what did we say? We said an income should be included in the total income of that country and tax should have been paid on that particular income. Only then it is called as a foreign taxed income. Only on such income relief is granted here in India. So such income is a taxed in foreign country, and straightforward. We said section 91. So of course there is no DTAA. No DTAA with that country. So when you say no DTA with that country, of course you can't claim, you don't have various articles which tell you which income is taxed where, how do you take credit, exemption or tax credit method. You don't have such provisions. So it says whenever there is no DTA with that country, section 91 falls. So these are the conditions with respect to section 91. So to repeat, the person must be a resident in India during the relevant previous year. Such income must deem to accrue or arise outside India, that is source-based taxation. And it must not be deemed to accrue or arise in India. So which means it could have been received in India but should not have been accrued or arising in India. So that's what you mean by the third condition. The fourth condition is it must have been taxed in that particular foreign country, and the last one is straightforward. There must be no DTA in that country. So that's what the next provision is about. So the next one we are talking about is foreign tax credit. We said a relief must be provided. We said tax credit must be provided, right? So this we said is called as FTC, that is your foreign tax credit. How do you provide relief? So how do you provide relief? So it's basically the Indian rate of tax. So you compute the Indian rate of tax. You also compute the rate of tax in that particular country. Whichever is lower is what the relief provided. So this is straightforward. Again, it is straightforward. So it's basically the tax in India for that particular income. So you take the average rate. If it's a person, right, you have a slab rate. So in that case, you take an average rate and the rate of tax which has suffered in that particular country. This whichever is lower is the rate, is the amount of tax that you will claim credit for that particular transaction. And when both are equal, of course, it is the Indian rate. So there is no difference between that, but still the rule says when both the rates are equal, you will have to adopt Indian rate. So now we need to understand what is Indian rate, what is foreign rates. So Indian rate is basically you take the total tax, that is your income tax. When you say tax, you don't talk about GST and all. So it is about your income tax that is divided by income after all your deductions, that is chapter 6A deductions, providing various relief that is available. For all that, you take that income and then take an average rate, that is income tax divided by this. This will give you the average rate for the Indian perspective. And what is other country? It is basically whatever super tax that is applicable to that, whatever income tax is applicable to that. So typically, the entire taxes, it could be the regular income tax that they are paying. If they are paying anything additional, as anything extra tax to be paid in that particular country, which is basically called as super tax, which is basically for anything extra that you are paying there. So that tax is also. So all taxes paid there will be considered. So the rate will be such tax divided by such income will give you the average rate. So that is what you do it for other countries. So whichever is lower. Now you take this Indian rate, you take this other country's rate. Whichever is lower is what you claim as the tax relief. We'll see a small example to understand this. So we are going to talk about a person, Shreya, who is a resident. She is employee of particular company. She is 60 years. Is a well-known dramatist deriving income. So she is also receiving income from foreign income, 1,10,000 paid abroad, on which tax of 11,000 was deducted. India does not have a DTA. So what provision it is applicable? We need to look into the provisions of section 91. So 91 says the income tax rate or the foreign tax rate, whichever is lower. So basically we need to know other information. Her income in India is 6,10,000 and she has deposited 1,50,000 in PPF, 30,000 in an approved LIC, 28,000 to health scheme, that is your 80D, medical insurance 20,000 to insure her father who is a non-resident, also aged 84. So we need to see whether this age is relevant here, who's not dependent on her. So 80D is available for self, that is family, self, the children and the spouse and the parents. So if they are senior citizen, it is allowed up to 50,000. If they are not senior citizen, it is 25,000. So that's how it is. So you get probably a maximum of 1 lakh, 50,000 for the assessee who is a senior citizen, 50,000 for the parent who is also a senior citizen. So that put together will give you 1 lakh. Now what happens? We need to compute the tax liability of Shreya. So we'll just see the gross total income is 7,20,000. We said it is 6,10,000 of Indian income plus 1,10,000 of the foreign income, the one she received for being a dramatist. So this 7,20,000 is your gross total income. What are the Chapter 6A deductions? PPF is eligible for 1.5 lakhs. LIC pension fund is also eligible under 80CCC. So put together 1.82, but 80CCE says it is maximum up to only 1.5 lakhs. Only situation where another 50,000 could be claimed is 80CCD. If you have invested there, you get another 50,000. And deduction under section 80D. So we said it's eligible for a family. She being 60 years old, she is eligible for up to 50,000. Up to 50,000. Since she actually has deposited only 28,000, you take this actual amount. For a father, since the father is a non-resident, it doesn't matter that the parent is dependent or not dependent. Since father is a non-resident, maximum eligible is only 25,000. So that's why we take 25,000 instead of the actual payment of how much was it? 26,000. So the actual payment was actually 26,000. So you should not take 26,000 because a father is a non-resident. So you take total of 2,03,000, you get a net total income of 5,17,000, which means an income tax of 13,400. That is, you have a slab rate, right? So in the slab rate, you take the slab rate and apply for 5,17,000. So for first 3 lakhs, you get 0. For the next 3 lakh to 5 lakh, you get 10,000. That is, for 2 lakhs, you charge 10%. For the next 17,000, you charge 20%. That is 3,400 of this 17,000. So 17,000 into 20% is 3,400. So total what you get is 13,400, right? So this 13,400 plus the education cess, surcharge and this health education cess of 4%. So you add that, you get 13,936. So this 13,936 includes foreign income for which you need to claim relief. So what is the procedure? You calculate the Indian rate. So we calculate the Indian rate. You also calculate the foreign rate. You take whichever is lower. So how do you compute the average rate? So basically you take this 13,936, which is your total tax, including surcharge, cess and everything. You divide it by 5,17,000, with which you get a tax average rate of 2.696%. So by dividing that, what is 5,17,000 is the net total income, because we said it is after providing all deductions and relief. So you take 2.696, whereas there it is 10%, that is 1,11,000 is the total thing, for which 1,10,000 if I am right? Yeah, it is 1,10,000. So this 1,10,000, 11,000 divided by 1,10,000, that gives you 10%. So that's the rate of foreign tax credit, whichever is lower. It's not a big math, right? So whether 2.696 is lower or 10% is lower. So you take this 2.696%, apply that on 13,936. So apply that on 13,936, you get this 2,966. So this much is what you claim deduction under section 91. So your difference, that is the rest of the tax is what is actually payable in India. 10,970. So hope you are very clear with this particular way of sorting out with respect to this section 91 on how do you actually find the foreign tax credit. There is an exclusive rule for this foreign tax credit. So we'll just have an understanding of that also. So as we said, foreign tax credit will be available in the relevant year in which that income is taxable. In the earlier example that we saw, Shreya was taxed on 1,10,000 in the previous year 21-22. So she is also availing credit on that particular income. So the year in which corresponding income is taxable is important. What if it is spread over the year? For example, we have calendar years, year, financial year. So what if it is actually spreading over a year? If it is probably in the same year, you take as it is. If it's probably spread over 2-3 years, then you take it in the same proportion, whatever proportion for that particular year, that is 21-22 financial year, for that previous year alone you compute. And when you say components of tax for a calculation purpose, you must include surcharge, cess and whatever is something of that kind, but you must not include. So you exclude interest, you exclude fee, that is 234F or whatever it is. You also exclude any penalty or something. So all this thing, that is 234A, B, C, E, F. So any kind of fee or interest that you're talking about is not allowed for the components for the purpose of foreign tax credit. And manner, we said, whichever is lower, right? The Income Tax Act as per the Indian rate or the foreign tax rate, whichever is there. Foreign tax rate, it generally does not give you as 10,000, correct? It doesn't give you as 10,000. So it is typically a TT buying rate on the last date of preceding month is what you take for consideration. So that is what is relevant for the taking rate. So you take the TT buying rate of the last month of the preceding month of the transaction. The next concept we are going to understand with this session is permanent establishment. So what is a permanent establishment? We have already discussed permanent establishment is basically a fixed place of business through which a business of enterprise is wholly or partly carried on. So there is some permanence in India where a business is carried out. So it could include various locations. So it could be in India, we say it is taxed on business connection or significant economic presence under section 9(1), subsection 1, clause 1. Whereas in your DTAA, it is taxable on permanent establishments. That's why this is important. What is permanent establishment? To understand that. So what could be a permanent establishment? Something like your poem, that is your place of effective management is important. It could be a branch, it could be an office, a factory, a warehouse, that is your workshop, or even a sales outlet, a warehouse, or a mine or an oil or a gas well. So it could be anything related to this thing for the purpose of extraction or any other place of extraction or natural resources. It does not include exploration. So exploration is not included in this concept. So a mine, an oil or gas or well. So mine, oil or gas well, a quarry or anything relating to extraction of natural resources. These are all the list of places or locations which could be considered as place of effective management. So these are the locations which are considered as permanent establishment for the purpose of DTAA. So DTAA Article 5. So Article 5 is primarily the article which discusses about this permanent establishment. So they say that it is applicable. That is, these are the locations which are considered as a permanent establishment. When you say every DTA has a specific clause which deal with an explanation of 5. That's what we called it as Article 5 is predominantly the article which talks about thing. A business income of a non-resident India will not be taxed in India unless such non-resident. So when we say business income, a business income, according to section 9 also, it is taxed in India only if it is attributable to India through a business connection or a significant economic presence, right? So BC or SCP is what is discussed in section 9. So similarly, Article 5 also says a business income, that is article which talks about business income, says only to the extent the business income is derived through a permanent establishment in India, only such income is taxable. So that's what we said. This is discussed in DTAA. Whereas your DTA talks about PE, your section 9 talks about business connection. So that is how a tax is derived. So the permanent establishment is a very important aspect for calculating applicability, deciding the applicability of the tax in the particular India. So what happens in India? So a non-resident will be subject to tax in India only if that person has a permanent establishment in India. So business is done through a permanent establishment. Only that income is attributable. It is exactly similar to section 9 business connection which we discussed, only to the extent attributable in India. So we could say that only to the extent such income is attributable in India. Please excuse my handwriting. So it is only to the extent it is attributable in India. So the next concept, when we say permanent establishment, liaison office is not a permanent establishment. So liaison office is generally not a permanent establishment, because the purpose of this permanent establishment, liaison office, is for some administrative work, something to support. There is no skill involved or nothing involved here. So it's not a business activity as such. So that's what you call by liaison office. So there are a couple of recent issues relating to this liaison office. So we'll understand that to probably just understand the liaison office better. So the first one is, what if there is an office which is involved in remittance services? So basically, as we said, India liaison office of a foreign enterprise engaged in remittance service would not constitute PE. This is what has been held by Supreme Court in the case of UAE Exchange Center. So they say, if you have an office just for the sake of collecting remittance and sharing remittances, such will not be considered as PE, because there is no permission by RBI to conduct that activity. There is no permission by RBI to conduct a banking activity or financial activity. So it is only to support. What was their activity? As far as India is concerned, they were downloading the checks or something, printing the checklist and couriering it to the respective location. So this concept is purely administrative. So what you call here is, it is preparatory or auxiliary in nature. Moment this service comes into picture, that is something which helps you as kind of support, an administrative support to the original business activity, will be considered as a liaison office. So this activity of downloading and printing and couriering is typically a administrative activity. There is no skill involved here. So there is no requirement of any skill here. So there is no business activity, and there is no activity, business activity approved by the RBI also. So for all these reasons, they say remittance services is not considered as a PE. It is only a liaison office. It is not considered as a PE. And the next one is related to communication channel. So there is another example that we are going to talk about with respect to a liaison office in the name of communication channel. So there is basically a project office. So they don't carry out the basic business activity. It is only to support. A project office is not a core place, of business, hence not a PE. This was held in Samsung Heavy Industries in the Supreme Court in the year 2020. Any case laws in a very recent year, let's say couple of years, is probably important for your exams. So these two case laws are probably very important for your exam. So just make a note of it. So these two things, that is remittance services and communication channel, are not permanent establishments, because it's only a liaison office, because the activity is preparatory or auxiliary in nature. So here also they said project office of this is between this ONGC and the assessee. That is ONGC and the Samsung Heavy Industries has entered into an agreement for having a project office here. There is no expenditure attributable to the services rendered here, and there is only two unskilled persons. So there is nothing related to skilled activity here. It is only to support the actual project. So these two unskilled persons for the core activity, but they are unskilled. They are not actually doing the core activity. These two unskilled persons are only for the purpose of supporting the core activity. So this is what you talk about as what you call, this is not an activity of a permanent establishment. So here also we are trying to conclude that this is only a liaison office and not a permanent establishment. So these two things, that is remitted and communication channel, are recent case laws in Supreme Court which rules that these activities are actually not business activities happening in India. It is only a liaison office. Hence such services, such activity will not be a permanent establishment for such non-resident. So that is what it is about. There is a small deviation for BPOs alone. So when you say BPO, it is basically a non-resident is outsourcing services to the Indian entity. the provision, this circular on 28 September 2004 very clearly says whatever non-resident has provided as an outsourcing services to the Indian entity, it is not a business connection, it is not a PE. So though non-resident has a control over the services outsourced, it is not considered as business connection and not a permanent establishment. It's a very specific exclusion to the concept of business connection. So when you say business connection is whether established or not, if it showed that there is something else more, there is actually a business connection. If that could be established, then it becomes PE. So generally it is not a business connection, but if something else could be established as a business connection, then it becomes a PE of that such non-resident. So once it is established, whatever is income attributable to that particular permanent establishment or because of the business connection, it becomes taxed in India. So it becomes taxed in India, right? So BPO has a very clear exception saying that it is generally not a business connection or a permanent establishment, but in case if it could be established, it becomes it is treated as a permanent establishment in India. And whatever extent the deduction or that is the expenses or whatever, when you say income attributable to the India, it is after considering the deductions and expenses. So whatever is exclusively attributable to the permanent establishment is actually considered as thing. And in such cases, one thing that is important in such cases is the circular says any transactions between this non-resident and this outsourced Indian person where business connection is established, such transaction shall happen in arm's length price, that is arm's length price, which is discussed in transfer pricing provisions. So we discussed that earlier. So whatever price is happening between this non-resident and outsourced Indian entity where business connection exists, such prices has to be determined using arm's length price. So this is all about this double taxation avoidance agreement and how it works out in particular in India as concerned. So hope you all have understood. So with this we wind up this session of double taxation avoidance agreement. Thanks a lot.